Sales prices are down on all metrics for San Diego housing. Pending sale declines are outpacing the new inventory coming to market. And inventory levels, well, that's something we gotta talk about. I'm Karl Kyler, your San Diego Realtor, and in this week's San Diego Market Matters, I'm updating you with the June data. I do these monthly updates where it's a little bit of a different dynamic for the San Diego Market Matters than what we normally do to kind of just give you the real pulse of what is happening in the San Diego market. Now, if you haven't liked and subscribed to my channel yet, please consider doing so now. And if you're thinking of buying or selling anywhere here in San Diego, my contact info is in the description below. Feel free to reach out if you have any thoughts, questions, concerns about buying. I'd be happy to help. Now, let's jump into this. All right, quick monthly snapshot. Year-over-year change in closed sales on all properties down 2.3%. Year-over-year change in median sales price on all properties down 2.9%. And year-over-year change in home sales on all properties is up 31.1%. What does that mean? Number of homes selling is down. The median sales price is down. Our inventory is up. Now, this is all sectors, so let's go ahead and dive into the micro numbers and we can see what they look like exactly. Kicking things off with new listings, we had 2,018 new listings come to market in the month of June. This is down 0.4%. I don't think that is significant. We can pretty much just say that's a wash and consider that close enough to being zero. On the attached side, it was an increase of 4.9%. We could just round that off to 5%, a 5% increase of new listings coming to market. So these are new homes that are coming to market on top of our standing inventory. Seeing this type of activity in the detached sector, so those are single family homes, homes that don't share any walls, seeing a slight decline or pretty much just a flattening this time of the year is really interesting for the detached side of the market. So typically this is where we see inventory go up a little bit more. Inventory tends to stay elevated during this time of the year into July and even August. And it's not till August, September that we start to see the winter curve where the inventory comes down. So seeing this at this time of the year is really, really interesting. What this tells me is that a lot of families or individuals in single family homes, not trying to isolate anybody here, they're not moving up. Okay, in past markets, once someone got enough equity in their home, they would move up into something bigger or the next opportunity. But we probably have two influencing factors here. Number one is affordability, okay? It's just probably too expensive to move up with current interest rates. And number two, we also have the lock-in effect. So homeowners that bought their home and they got into an interest rate that's sub 5% or maybe even in the 5% range, it's probably hard for them to stomach selling their home and upgrading to a higher interest rate. A lot of people will chop that up to an affordability issue, but not exactly. What I hear a lot from homeowners is that it's just hard for them to give up the idea of having an interest rate at 2 or 3 or even 4% on their current home because the cost of that money is just so low. For them to lose that, that's a hard pill for them to swallow. It's not the fact that they can't afford to move up, it's just hard for them to stomach losing that interest rate. And instead they're considering or they're looking at ways of holding on to that property for the long term. So maybe staying in it for a couple more years and then moving up to maybe a 6 or a 6.5% interest rate, and then keeping that property with the 2, 3, or 4% interest rate and keeping that as a rental. Real quick before we move on, year to date, that's just from January until now, in the detached sector, we're up 12.3% on new listings, and on the attached sector, we're up 19.5, practically 20%. Again, we're not seeing as many single family homes come to the market as much in comparison to the attached side. We've been seeing the attached sector of the market just grow more in inventory. And in this context, we have a little bit low year over year, and then our year to date is up, but just not by as much, not in comparison to what it was last year. Now, if you look at the year over year declines, we can see this trend of declining inventory coming to the market all the way back to January. So in January, we had 23%, then we're up over 19, then in March we were over 16, then in April we were at 15%, then 4%, and then this month we're at -4% or just practically zero. So we've had this decline in new inventory coming to market on the detached side. Now we have something kind of similar on the attached side as well, But if we look back to January all the way through April, it was kind of just up, down, up, down, up, down. But over the last 2 months, we saw the decline, 10.5% last month, or not last month, but in May, and then 5% practically in the month of June. Something to consider here is if we continue to see new inventory come to market that outpaces from the attached side to the detached side. So if we see more homes coming to market on the attached sector than the detached sector, that's gonna put more pressure on the detached side of the market, okay? So all of these people that are selling their homes on the attached side, they're gonna be moving into the detached sector. They're gonna be moving up. That's not including all the individuals that are coming straight into the detached market without having to sell an attached home themselves. What I want you to take from that is if we have that kind of pressure coming into the detached market, what we will likely see is this kind of an interesting dynamic where the number of homes coming to market on the attached side is going to create a lot of inventory, a lot of volume, but there may not be as many buyers because a lot of buyers are going straight into the detached market, right? So you're gonna have kind of a stagnation in pricing and possibly a drop because the volume, right? And then you're gonna have this pressure on the detached side where you have first-time buyers as well as move-up buyers going into the detached sector, which is that's gonna solidify, probably even hold their prices and possibly bring them up. The market is still trying to figure itself out if it's gonna go into a buyer's market or if it's gonna teeter back to a seller's market. Obviously, in either direction, the dynamics are gonna be very, very unique to the time. So if we say we go back to a seller's market, which I'll tell you more about what I think is gonna happen at the end of the video, but say we go back into a seller's market, it's very, very unlikely, like extremely unlikely that we will go back to anything of a seller's market like we saw in the early 2020s, right after COVID, where prices were just going through the roof. We saw mass demand and inventory that can't keep up. We won't see it. Very, very extremely unlikely we'll see anything like that. Next, pending sales. These are negative numbers across the border. So we're down 7.1%. We have 1,260 homes that went into pending in the detached sector. That means they accepted an offer and went into escrow. Then we had 663 properties go in on the attached side of the market. That's down 4.2%. If we look year to date on the detached sector, we're down 1.3% year to date, and we're down 5.1% year to date on the attached side. Pending sales is a very, very important number that I impress upon all of my sellers more so than I do sold properties. Sold tells us what the market was doing. New listings tells us kind of what we're competing with now. Pending tells us where it's going. This data tells us two things that are really, really important. Number one, we are seeing less homes go into escrow, which means our sales closed or closed sales for the month of July will also be down because we're seeing this pending down significantly. It's not disaster warning, red flag, sound all the alarms or anything like that. But it's down, and it's down a significant number, a notable number, right? So we're gonna see this show up in the July closings. The second reason these numbers are important is if we compare this to the new listing data. So if we have less homes going into escrow and our number of new listings is increasing proportionate to the number of homes going into escrow, then what's gonna happen is our inventory is gonna continue to increase, which pushes us towards the dynamics more so of a buyer's market. So inventory is gonna increase, buyers are gonna have more options, homes are gonna sit on the market longer, buyers will be able to negotiate more. This is exactly what we're experiencing that we've been moving very, very slowly into. Buyers are gaining negotiation power back, right? I actually have 2 buyers right now that I'm working with, and in both cases, these buyers, we are negotiating temporary rate buy downs and closing cost coverage. Now moving into closed sales, we're down 2.2%. We sold 1,272 on the detached side, down 2.5% on the attached side. Closing out only 672, so very comparable, right? 2.2 to 2.5% decline in sales on both detached and attached. That's really, really close. So we're seeing it happen on both sides. Now, if we look year to date, both of them are down, but not as closely, right? So on the detached side, we're down 0.3%. You could pretty much just say that's a wash. But on the attached side, we're down 5.3%. Now, if we step back and look at the data over the last, let's just say 6 months, it's all over the place. It's up 6.9% in January, then down, down, up, down, down on the detached side. On the attached side since January, it's down, 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 up, down, down. So the numbers are all over the place, up, low, down, high. It's really inconsistent. What this is telling me is that the market's trying to figure itself out. You have a buyer's market, a seller's market, right? They're always teetering back and forth, but when they're pretty comparable, they're close to being even out, that's a neutral market, and this never stays for very long. What this is telling me right now is the dynamics seem very neutral for San Diego, okay? Now, San Diego specifically, right? The Northeast is still going off with positive numbers. The South is struggling along with Texas with high inventory, so they're having prices come down. Here in San Diego, we're showing some neutralness, right? A neutral market where buyers haven't totally taken all the negotiating power, but at the same time, sellers are still retaining some price growth here or price stability. Moving on to median sales price, we closed out in June at $1,075,000, which is down 0.9% or 0.1%. Again, I think that's close enough to zero just to say it was pretty much a wash. It was about $10,000 difference. On the attached side, we were down 4.4%, something a little bit more reasonable to take note of. And that is obviously in a response to the higher inventory levels we're seeing on the attached side. So my first time buyers that are going into the attached route, we're looking at better deals for them, right? So if we're looking year over year, we saw almost a $30,000 difference in price from $690 last year to $659,500, practically $660. So a $30,000 price difference in median sales price. A lot of my first-time buyers are either getting that price to come down or the seller brings the price down, and then we're also able to negotiate. Not always, but in a lot of cases, we're able to negotiate some credits here or there, or maybe in the request for repairs, the seller's given us a little bit more with taking care of some issues or giving us credits so that my buyers can take care of those issues themselves. Now, even though we see a negative on the median year over year, we do have positives and a flat on the year to date. Year to date, we're up 1.6% on the detached side, and on the attached side, we're flat. We've had no gain, no loss on that side. So interesting dynamics here, right? We saw a small negative year over year, but year to date, we're showing some growth and stability. Again, this only further contributes to the support of my claim that it feels like we're kind of in a neutral market right now, just waiting for something to tip us in one direction or the other. Average sales, something I prefer over median because I think it gives us a little bit more of an accurate depiction of the market. We're down 6.1%, a little bit more significant than what we saw on the median side for detached. And then we're down 1.4% on the attached side. Again, something that's a significant difference from the median sales. Medians was over 5%, while the average on the detached side is down 1.4%. Now, year to date, we're down 0.2% on detached homes, which let's just say that's pretty much a wash. And then we're up about 1% on the attached side. So see how these dynamics are very like push and pull. We're trying to figure out well, what's really going on here? All right, wrapping this up shortly. Days on market, this is a number that's up significantly. We're up 22.2% year over year on detached, 27.6% on the attached side. Year to date, again, positive numbers, up 17.2% on detached homes, up 31% on the attached side. This is significant. And I think for San Diego's dynamics, like what we're used to, if you see this number get to 45 days or more, that's when you're gonna start to see more presence or more certainty of us being in a buyer's market. Now, that's not the true definition of a buyer's market, but I think for the context of San Diego and what San Diego is used to, once we hit to 45 days as a days on market average, then we're gonna be pretty certain to say, okay, cool, we're in more of a buyer's dynamic market at the moment. Now, inventory of homes. Here's some really interesting data. We're up 27.1% on detached, right? So 3,801 homes. That's our total inventory. That's new inventory, that's new homes coming to the market plus standing. On the attached side, 2,630, that's up 37.3%. Now, let's look at the year-over-year change all the way back to January. 41%, 47, 47, then 42, down to 34, down to 27 on the detached side. Our inventory growth is declining. It shouldn't be going down in June. It should actually still be up. This is an interesting dynamic. If the amount of inventory coming to the market is showing that same trend that I referenced in the new listing section, then we might see that balance, right? That buyer balance might stay a little bit, or I should say buyer balance, that buyer-seller balance, it should stay in limbo a little bit longer than expected. On the attached side, we're up 56%, 64%, 76%, then it starts trending down, 71, 56, and now 37%. The inventory is coming down as well. Again, as I mentioned on new inventory, I think this is in part due to lock-in effect that is limiting the number of homes that can come to market. And as we have fewer and fewer homes that can come to market, that number will shave off. This will be a very, very interesting metric to continue to follow. And this will be a major determining factor as to whether or not the scale will tip in favor of buyers more over the next 1 to 2, maybe even 3 months, or if it'll tip back to the side of sellers. And to wrap things up, here is your total market overview. New listings total 3,330, up 1.6%. Total pending sales, 1,923, that's down 6.1. Again, this is total inventory, so it's attached and detached smashed together, all numbers. Closed is 1,944 in the month of June, that's down 2.3% year over year. Median sales price is $915, average sales price is 1,161, so a little over 1.15. The days on market is up to 35 days on the market, which it was this time last year, 28. And total homes for sale, 6,431. This is a good number. It's up 31%. It grew fast, but we need the inventory. All things considered, what we really need is for mortgage rates to hold, inventory to climb just a little bit more. Then we're gonna have a kind of a continued flatlining maybe of the value market, and this allows people's income to improve, people to continue to save, and then we can work on bringing affordability back into the picture by either bringing down interest rates, which makes the fastest impact on affordability, or we'll bring down pricing, which doesn't have as much of an impact on affordability, but I'm gonna cover that in another video. Now, real quick, let's cover what I think is gonna happen to the market based on the data here. I get asked that a lot. Now, mind you, this is what I feel and what I think is gonna happen in the market. Do your own due diligence and make your decision to buy or sell, or not to buy or sell, based on what you think the market is gonna do and the research that you do for yourself. Based on the data that we've covered in the video so far, as I've mentioned, it's pretty clear that we're kind of in this limbo, this neutral-ish market where the market's trying to figure out what direction it's gonna go. Is it gonna go negative? Is it gonna go positive? But bottom line is we're approaching this flatlining in the market. And what we really need to see is something happen in governmental policy that's gonna tip it in one direction or the other. Now, if mortgage rates come down, which is very likely to happen, and we're already seeing that happen, we're sub 6%, or I'm sorry, not sub 6%, we're sub 7%, and we're doing really, really well in that aspect. As that number comes down to 6.5, or if it breaks even it below 6.5, I think that the affordability issue will be solved for enough people to tip the market into the direction of sellers. Now, I don't think that we'll see a market like we saw in 2020 or 2021. At the same time, I don't know, I'm not confident to say that the buyer dynamics that we're seeing right now are gonna last very long. If they last through the end of the year, I will be very surprised if they go for that long, but I do think that it is very possible. So if you're looking to buy, just buy based on the financial feasibility of owning a home right now. Can you afford the payment for the next 5 to 8 years as a worst case scenario? That's not to suggest that the market is gonna go down. It just means that I think the rate of growth is gonna take longer for you to get a good return on your investment for living here in San Diego. And I think that could take up to 5 to 8 years. Now, if you're looking to make a move and you're going to post up for 5 to 8 years, then you're probably in a safe place to buy now. And that way, if the market tips in favor of sellers and values go up, you're already ahead of the market and you can refi when rates come down. and you'll get a softer payment, giving you a little bit more breathing room. Again, these are my thoughts. The data changes every month, and I'm going to continue to modify and adjust my views of where the market is going with every month and with the new data that comes, along with everything else that is being posted regarding monetary policy from the government and tariffs and wars and such like that. All of those factors influence how I feel the market's gonna go. So make sure that if you're looking to buy or sell, feel free to reach out to me. I'm happy to have a discussion with you, but make sure you do your own due diligence and educate yourself as well. And that's it for this week's San Diego Market Matters. If you enjoy the material that I bring to you in these almost weekly market updates, please consider liking and subscribing to my channel. I'm really close to hitting my 500 subscribers. Thank you if you have subscribed in the past and you support my channel. Now, if you have any thoughts, questions, concerns, don't hesitate to reach out. As always, I'm Karl Kyler, your San Diego Realtor. I'll see you in the next video.